So this just happened. Banks finally slipped and admitted something they've been trying to downplay all year. More people are falling behind on their mortgages again. The late payment rate just bumped up to about 4%. That's 2 quarters in a row now. After years of steady improvement, the trend just flipped. And while that was happening, about 103,000 homes slid into foreclosure in just 3 months. That's a 23% jump from last year. And almost all of that pain is sitting in FHA loans, the government-backed stuff built for first-time home buyers and folks with thinner savings. For them, being 90 days late is now about half a point worse than it was a year ago. Everything else looks flat. So that tells you exactly where the cracks are forming. And here are the key takeaways that you want to remember. First, yes, late payments are still lower than the last 20 years, but direction matters. It's not getting better, it's slowly getting worse. Next, foreclosure starts are climbing, but banks are keeping total foreclosures below where they were before the pandemic. Now that's not an accident, that's management. Also, this isn't hitting everyone. It's hitting people who bought with the smallest down payments and the tightest budgets. So when your house already takes most of your paycheck, one bad month, it's all it takes. And finally, banks aren't dumping homes. They're stretching borrowers out with modifications and deferrals to avoid a flood of cheap listings. So the top layer of the market looks calm. Underneath, the pressure is building. And to make this simple, it's like this. You've got guests coming over. Your kitchen looks like a crime scene. So instead of washing the dishes, you just shove everything into the oven, wipe the counters, and hope no one looks too closely. That's the stable housing market headline. Looks fine from the doorway, but open the oven and just everything falls out. Those hidden dishes are the late FHA loans and the slow drip of foreclosures. And here's what this releases. You don't have to buy the everything's fine story anymore. You can watch the real stress points, the FHA heavy neighborhoods, the buyers from 2020 to 2023 who stretched to get in. If you're an investor, there's a new lane opening up. Owners who are behind, not listed yet, and quietly looking for a way out before the bank shows up. If you're a homeowner who's tight on cash, this is your warning light. The bank might be patient today, but patience doesn't last. And here's why it matters. The first people who get squeezed are the ones with no margin, 3% down, thin savings, housing bills that already eat the whole paycheck. When that group starts slipping, you get more quiet distress. People months behind, still living in the house, hoping paperwork saves them. You get a slow trickle of must-sell homes in the starter home zip codes. Banks start tightening rules. Little things at first, a tougher debt-to-income call here, a stricter FHA overlay there. It gets harder for the next borderline buyer to qualify. Give this a couple years and neighborhoods start softening, not because everyone sells, but because the weakest owners get forced out one by one. That hits values, it hits local economies, and it becomes political fast. And when it comes to the quiet part no one is saying out loud, banks don't want these homes. When they take them back, it wrecks earnings and stock prices. They're scared of a 2008 flashback, and so are regulators. So the official line is, we're normalizing, while the real play is slow this down so nobody freaks out. FHA stress is also a political problem. When government-backed loans go bad, voters notice, campaigns notice, budgets notice. But here's what the experts are saying. The mortgage trade groups say performance is still solid, and on the raw numbers, they're right. Delinquencies are still below what we used to call normal before the pandemic. The data firms say foreclosure starts are up double digits, but still below 2019, so they call it normalization. The foreclosure trackers are louder though. They're pointing out filings rising quarter after quarter. They're seeing the stress before anyone else says it out loud. And the pushback is coming from contrarian economists and regular folks online saying, if banks stop stretching this out, the numbers would look a whole lot uglier. The experts mostly agree the level is still okay. They split on what the trend means though. I mean, here's what most people are missing. Most people hear delinquencies are low and think the danger is gone. But danger doesn't show up in averages. It shows up in clusters. And the cluster right now is FHA and the thin margin owners from the boom years. Another thing people miss, this isn't set up for a dramatic crash. It's set up for a long, controlled bleed. Servicers are automating modifications and deferrals at scale. That keeps people in houses just long enough to avoid a headline. And life costs, food, gas, healthcare are hammering the same people who are already behind. So the average chart looks calm, but the edges are cracking. As always, there are two sides to this story. Side A says this is just the market going back to normal after a weird protected few years. Side B says the trend and where it's showing up matters more than the level. And that FHA stress today looks a lot like early subprime stress in the mid-2000s. And here's what the smartest person in the room is thinking. They're not asking, is housing crashing? They're asking, where is stress starting? Who's holding the bag? And where will the extra inventory pop up first? They're mapping that out now while everyone argues about national headlines. But here's what everyone wants to know right now. Are banks hiding a new foreclosure wave? No, they're not hiding it, they're pacing it. Why are FHA buyers getting hit first? Well, because they had the least room for error. Does 100,000 foreclosures in a quarter mean a crash? No, not by itself, but if it keeps rising, it shifts the tone. Is this 2006 all over again? No, different loans, smaller scale. But the rhyme is there, a little. Should I still buy in a paced default market? Well, only if you buy with cushion. If you're stretching to the max, the ice is thin. Yet, here's what we really need to know before we know what comes next. What loan types dominate your local area? How far your local prices ran up since 2020, how fragile your neighbors really are once you add taxes, insurance, and repairs, and what happens if the job market slips harder. If you have insight on any of that, drop it in the comments below. Your zip code, it might tell the real story. And has this happened before? Yes. And here's how it ended. In the mid-2000s, the cracks showed up on the edges first. Subprime, weird adjustable loans, defaults rising from tiny levels while the broader market looked solid. People, they brushed it off, then it rolled into forced sales, tighter lending, and the meltdown everyone remembers. Today isn't that scale yet, but the pattern is familiar. Stress starts quiet and local, then the economy or policy decides how big the ripple gets. So the takeaway for the next 2 to 3 years is simple. Watch the plumbing, late payments, local foreclosures, forced sellers, not the national median price. Quick translation here is, if you're a small landlord juggling rentals and a W-2, this is your wake-up call. Your tenants are getting squeezed. Some are one surprise away from being late. The ones who carry heavy consumer debt are even more fragile. So here's your move. Choose stable employment over top dollar rent. Keep 3 to 6 months of expenses on hand so you're not the forced seller. And stop asking, how high can I push rent? Start asking, how long can this person stay solid if things get bumpy? That shift protects you more than any headline. And when you follow this trail long enough, you start seeing something most people never notice. When a home finally goes through foreclosure, the sale price doesn't always match what's owed. Sometimes it sells for more, and that extra money doesn't go to the bank. It belongs to the former owner, and most folks never see a dime of it. I mean, they move out, they give up, and thousands of dollars sit in a county account, untouched. And that's why I pulled this one out for you to watch next. The one that breaks down what those surplus funds are, why they pile up, and how people just walk away from them. You'll see how it actually works, why the rules allow it, and how you can help someone recover money they didn't even know was theirs. It's simple, it's wild. Check it out. Once you understand it, you'll never look at foreclosures the same way again.